Hello, everyone. I have Lance Roberts here from Real Investment Advice. Now, if you're a subscriber to the Money GPS, you know him, and I want to thank him for being on today. If you have seen the show before, you've seen Real Investment Advice, and I know specifically that all the charts, all the articles are just absolutely fantastic. But for those who are not aware, would you mind, Lance, just giving a quick overview of your website and services?
Sure. Yeah. Realinvestmentadvice.com was actually an offshoot of our corporate website at a firm I was with previously. And what happened is that, there's all this kind of commentary, this media kind of environment where you kind of get always the bullish case. Nobody ever talks about managing risk. And as a portfolio manager and as a wealth manager, and I've been managing money for institutions and banks and high net worth individuals for 30 years. And, regardless of the cycle, the market, where everything's going on, people that have spent a lot of time earning money, making money, they don't want to lose it. That's really the key thing. And the majority of the time when I meet with a family office or an institution, they're like, look, I want to make some money, but don't lose my money. That's the key number one factor. And nobody ever talks about risk management. They never talk about the thing that comes up that you're not expecting that takes away a very large amount of your capital very quickly. So that's why we really kind of launched Real Investment Advice, was to talk about the things kind of behind the scenes. So when you look at headline numbers or headline economic data or the debts or the deficits, that's fine. But what does that mean longer term? What does that mean to your future prosperity? What does that mean to capitalism? And look, there's a lot of people right now very upset with capitalism. It's like capitalism sucks. We need more socialism. No, capitalism doesn't suck. It's what makes America the wealthiest country in the world, not by a little bit, but by head and shoulders wealthier than any other country in the world. Corporatism, though, because of what the Federal Reserve has been doing for the last 20 years, does suck. And that's where, that's what people are angry about. And so when you look at what's happening in our economy today, everything from social justice to a lot of these riots and things that you see going on in the economy, yeah, they have very specific tenets that they talk about. But what's really driving this is the wealth inequality that is occurring because of the economy and what's happening. People don't riot and get upset when they're making plenty of money and their families are happy. They riot when there's a disparity in what they feel is an injustice. And that derives ultimately from the financial deviation we've got in markets. But so this is what we talk about, right? And these may not be implications that occur in market, a market correction today, tomorrow, next week. But these are the things that cause losses of capital that are non-recoverable over time. And so those are the things we really focus on.
Well, excellent. I want to really expand on some of those here. And the first thing that I want to talk about is the taboo subject of inflation versus deflation. And of course, I've shown your articles and all of the charts and so on to the subscribers, but let's break it down. Of course, I want you to just, before I say anything, please, inflation versus deflation, I'll put the ball in your court.
No problem. How about a little of both? This is going to be the interesting thing going forward. When we talk about, oh my gosh, we're going to have this inflationary environment, we never talk about it in terms of timeframes. When we talk about deflation, we don't talk about it in terms of timeframes. So right now, yes, we have inflation in the market. This is caused by a variety of issues. One, massive stimulus printing. We put 20% of the GDP in terms of debt-funded stimulus into the economy all in 1 year. So yeah, you're going to have inflation because people are going to run out. You give them free money, they're going to run out, they're going to buy stuff. That's going to cause prices to escalate. Combine that with the fact that you've got a disruption in supply chains that led to an inability to produce product at a fast enough rate. That's going to further exacerbate the inflation situation. So things like used cars, houses, those make up 50% of the total CPI calculation in terms of the increase, not the actual calculation of CPI, but we look at the amount of the increase in CPI, 50% of that was house prices and car prices. Well, those are going to reverse as more cars, as the semiconductor shortage gets resolved and as supply chains become undisrupted. We're seeing that now, by the way. That's the early stages of that. those prices are going to fall. Housing prices are going to come down. So we talk about inflation in the short term. Yes, we have it in the short term. Longer term, we're going to have more deflationary pressures. And those are going to come from the fact that, A, housing prices can't stay where they are indefinitely. You're pricing people out of the markets. Take a look what's happening with rental rates now. Rents are coming back up because people are going, hey, I can't afford to buy a house. I'm going to go back to rent. So that's going to cause housing prices to fall. That's 30% of your calculation. Cars are going to get reversed at some point. However, there is a sticky side to inflation. And there are some aspects of inflation that will not go away. And this is going to be the thing that where the Fed is going to get into a very difficult trap. They're talking about inflation being transitory. They're right. When they look at CPI, it's going to revert back to about 2% growth in terms of CPI. The reason is that inflation, interest rates, and the economy all track at about the same level. You can't have 4% inflation and 2% economic growth. You can't have 5% interest rates and 2% economic growth. Those just don't work that way. Those all work together. There's a very high correlation historically between those issues. So at 2% economic growth, which is where we're going to wind up next year, CPI is going to decline to 2, and interest rates, guess what? They're right around 1.2, 1.5. They're going to stay there. And in fact, interest rates are telling us that economic growth and inflation are going to quell over the next 12 months. But the inflation that matters is the part of the inflation that we don't discuss and the things that the Fed doesn't pay attention to. And those are the sticky forms of inflation: food prices, utility costs, gasoline costs, the things that people pay for every single day, week, and month out of their paycheck. Those inflationary prices are not going to reverse, and those are going to be sticky. And if they're sticky in two forms. Either we have shrinkflation, which is where you go out and get less for the same amount of money, think like a bag of potato chips, or you pay for higher gasoline prices, higher utility costs, higher electric costs. And those things are going to be sticky. And this whole transition into climate change, and we need to fight climate change. And Joe Biden now wants 50% of cars to be electric vehicles by 2030. Sounds fantastic. I don't have any problem with that, except for the fact our electric grid cannot handle that much demand, and your electric costs at home are about to surge over the next decade to where they're going to be a massive input cost into your daily living standard that is not accurately accounted for in CPI. And combine that with the fact wages don't rise or aren't rising and will not rise in the future, that's going to be more problematic. So again, back to what I said, a little of both.
All right. Now, I have this scenario that I've been thinking about where we have obviously the Federal Reserve printing a heck of a lot of money, and you've got the velocity of money dropping significantly as they do this, and that money is kind of circulating within that financial system, but it's not really making it out into the public and so on. We do have the stimulus that's being given out, the stimulus checks, and you got the infrastructure bill, and who knows what's going to happen with that, and so on. But I wonder if we see real deflation coming in and asset prices start to fall and housing prices start to fall, are we going to see a time in which there's going to be helicopter money that's being given out? And the second part of that would be something like a universal basic income, potentially, where the government starts raining cash from the skies in order to fight off that deflation. And then we enter into a heavy inflation, perhaps even a hyperinflationary scenario. If you wouldn't mind expanding on that at all.
Yeah. Well, I think so. First of all, hey, we've already tried this, right? We did UBI technically in 2020. We sent checks to household. This was the first experiment into universal basic incomes, modern monetary theory, which, by the way, is neither modern monetary or a theory, but that was that first real experiment, and this is now a new tool. So, to your point, absolutely. If we get into another environment where the market's down 30, 40%, we get into another recession, the first thing that politicians are going to do is, hey, let's send checks to households, right? It worked last time. Let's do it this time. The problem with this is really several things. The first is that this is debt-funded stimulus. So The problem with debt-funded stimulus is it now requires more than 100 cents on every dollar just to pay for Social Security, Medicare, Medicaid, and interest on the debt. All the tax revenue you collect just goes for those things. Everything else, defense spending, education, whatever else you want to be paid for, on extra child credits, whatever, that's all funded out of debt now. So we're rapidly increasing that amount of debt that we have relative to GDP. And yes, the general consensus at the moment, and this is really kind of the caveat of MMT, is that, hey, it doesn't matter. Debts and deficits don't matter because we can just print money to pay for them. It's a balance sheet equation, right? More debt for the government means more household savings. It doesn't really work that way, because people only have so much money to spend, and they're spending every single cent of it just to make ends meet every month. And I run a chart on a regular basis. I look at the national median incomes relative to the standard of cost of living versus savings rate and personal credit. And what you find is that since 1990, it has required every dollar of savings of the average American and all of their income just to make ends meet and just to sustain their standard of living, plus an increasing level of debt. Right now, the average American goes into debt about $4,000 a year on average just to keep their standard of living going, right? That's not improving it. That's not decreasing it. It's just, I'm just trying to get my 4 kids through school. That's it, right? So $4,000 every year, that debt's just piling up. And this leads to slower economic growth. And this is why we continue to grow at 2%. Here's something for your listeners to remember. And we forget about this, and we've forgotten about this over the last really 2 decades. Prior to 2000, if you had 2% economic growth, that was worrisome, because 2% economic growth isn't fast enough growth to absorb the population growth. It's called escape velocity. You've got to be above 2% growth to absorb new entrants into your economy. Below 2% is pre-recessionary. That used to be a worry. Now we're just hoping we can get 2% growth and we're happy with it, because that's where we really are. And so everything that we're doing, debts and deficits, it leads to slower and slower rates of economic growth. So yes, politicians are now in a spending drunken binge here at this point, because they feel like there's no consequence, right? I just printed debt and the economy's growing at 6%. Sounds awesome. Until next year, that's going to drop back to 2%. Okay. Second part of that equation, UBI. Let's talk about that for a second. Here's the problem with UBI. It sounds great on the surface. There was an article out recently that Joe Biden lifted the bottom 20% of the population out of poverty. And he did. All this stimulus lifted people out of poverty. And it will happen for 1 year. Next year, they will be right back into poverty again because they didn't get any more money. And this is the problem with UBI. So basic math in terms of economic growth and how it works. Let's say the economy is 0. And I give everybody in the country $1,000 and they go out and spend it. So now our economy is growing at $1,000 nationwide. Sounds great. I've created $1,000 worth of growth, and I'm the greatest president ever on the planet. Next year, I give everybody $1,000 again. What's the growth rate of the economy? It's 0, because I spend the same amount of money. Growth in the economy is built upon what happened this year versus last year. So in order to make the economy grow, I've got to give everybody $2,000. The problem with this also is that when I give everybody $1,000, all the manufacturers, the producers, the service providers, and let's talk about child tax credits for a second, right? We're going to give everybody, more child tax credits to take care of their kids. Awesome. What is it that the child providers are going to do? They're going to raise their costs. When government took over the student loan business in 2008, what happened to college tuition? It went through the roof. Why? Because all of the colleges said, government's going to pay for it, UBI. Great. We'll raise our costs. And it's now priced people out of education. Before 2008, college costs rose at about the rate of inflation every year. It was very affordable. People could afford to go to college. Couldn't after 2008. So this is always the problem with these ideas about socialism and UBI and give me money for free. Nothing's for free. You're going to pay for it either through inflation or you're the taxpayer that's going to be footing the bill for it, or ultimately it's funded by debt, which leads to slower economic growth and a wider dispersion of wealth disparity in the economy. And all these effects are right in front of your face right now if you only pay attention to it. These are not good solutions. And the one last statement here. Everybody says, well, we can print money and print debt because it's no problem. Look, Japan's at 250% debt to GDP. They haven't blown up yet. You're right. They haven't blown up yet. But they have no economic growth since 1990. And interest rates are near zero. And they have rolling recessions every 3 years. The average young Japanese citizen can't get a job. They can't get married. They can't find good work to really make ends meet. And they've got an aging population into a pension system that is virtually bankrupt if it wasn't for the government funding it. Japan is not the model you want for your kids in the United States.
Absolutely. I see that all the time, the argument of Japan and how fantastic it is because they've been doing it for so long. So we can all do that. This is the key. You know, the Federal Reserve has been here since 1913, but suddenly after 2008, they figured it out. We'll just print money. Hey, no problem. But of course it has consequences as you just spend time, breaking it down. I have one question for you right now. Where do you think, I'm talking about short term, where do you think the weakest link is today? I have my own opinion, but let's hear what you think.
The weakest link in terms of the economy, markets? Sorry.
Yeah, well, anything, to be honest with you. I would say like in the financial system itself, whether that is, let me just say mine, like what I believe is the commercial mortgage-backed securities are probably the weakest as it relates to the office and retail, just because there's so many vacancies, and this goes, stretches from pretty much everywhere around the world, any major city. So that's what I see. I think that could create a potential catalyst for failure. But anyway, what do you think?
No, I think you're right on. Look, the weakest link in any environment is always a credit event, right? So, we always kind of worry about, China, they could, they might attack somebody, or, the South Sea, and we're gonna have a big war over there, or, we're gonna have Russia's gonna do something geopolitical. Those aren't the things that really screw up economies generally. Actually, I hate to say this, but war is a good thing for the economy because we spend money. The thing that always cracks an economy ultimately is debt, and it's a credit-related event. So 2008, you can talk about that in particular. Now, 1999, a little bit different. That was a dot-com bubble, and there was credit-related problems underneath that whole surface, but basically had a lot of companies that shouldn't have been companies that were public that ultimately banked. So the dot-com bubble is a little bit different, but primarily you go back through history, there's always a underlying credit-related issue for most major market downturns. And you look at where we are today, triple C credit is triple C credit. These are bonds that are basically one step above default. And this is basically you loan money to your cousin Vinny that's never had a job before, and he never pays you back, and you lend him more money, right? And this is what we're doing with these companies, is that these are companies that are going to default. It's just a function of time. And, the Fed's been bailing them out with low interest rates, and they've been able to access credit markets because of low interest rates and easy lending standards. And these are what we call zombie companies, by the way. We have a record number of those companies in the markets right now that people are buying. And those, at some point, you're going to get a disruption within the credit markets. And I absolutely agree with you about mortgage-backed securities. There's a lot of risk in that area. Collateralized loan obligation bonds. But again, you get down into the junk bond markets, your triple C, double C credit markets. Those are trading at yields that they should not be trading at. You should not be, buying a triple C credit for sub 3%. The interest rate on those bonds are the reflection of the risk that you take. And, triple C credits normally, are 9, 10, 11, 12% because you take a tremendous amount of risk in buying that debt. And that risk that we talk about has been wrung out of the market because of what the Fed's been doing. And that's a very dangerous situation. So I suspect at some point that the weakest link is going to be a credit event. When does it show up? You never know what causes it. I don't know what's going to cause it. You don't know what's going to cause it, but it will. The three things that your best leading indicators for a reversion in markets or a reversion in the economy is going to be ultimately a Fed beginning to taper, the Fed hiking interest rates, and an inversion of the yield curve. Now, none of those are happening just yet. But whenever one, two, or three of those start to happen, either by themselves or together, you're going to wind up with some major market reverting event. And, the yield curve is flattening. It's not negative, but it is flattening. Yields are falling. And those are telling you that there's something not quite right with the economy. The Fed is talking about tapering and potentially hiking rates. They may be getting themselves into a box where they have to do that. So those are the things that I would watch, because ultimately those are what's going to trigger some type of event somewhere in the market.
Interesting. Thank you for that. So the people listening today, if they've got their portfolio set up and they're seeing the risks that we're highlighting here, what kind of changes or what should they be looking for in their portfolio to kind of make it safer, make it more secure? Traditionally they would say the 60-40 split between equities and bonds, and that was sufficient. Or many people have talked about, bonds are outdated, let's go 100% equities. Is there anything that people should be looking at in their portfolio to kind of make it a little bit more sound over the long term?
Yeah, well, it's interesting. A lot the 60-40 portfolio has gotten a lot of grief lately, so to speak, and that's really by people that are generally promoting some product or an ETF or something like that. They're trying to sell you something. The 60-40 portfolio allocation is still one of the safest portfolios to be in, regardless of where you are. Look, bonds have been doing great over the last several months. They've been doing better than the stock market, and what bonds offer you in terms of protection. Now, I'm specifically talking about treasuries at this point. I'm not talking about corporates. I'm not talking about, other mortgage-backed securities, although those can play a part in this. But just for simplicity's sake, talking about treasuries. Treasuries are a risk-off hedge. So, for instance, over the last, starting about 3 months ago, we started buying TLT and adding that into our portfolio mix and increasing the duration of our bond portfolio. We run 60-40 models for our clients specifically because they help us manage risk. And so as we saw interest rates peak and begin to come down, we started lengthening the duration of our bond portfolio. It's helping us outperform our benchmark this year. And that provides that ability to absorb risk, because when something goes wrong in the markets, either domestically or internationally, the first thing that's going to happen is money going to come out of equities. Well, it's got to go somewhere. And if I go into cash and I'm a foreign investor, that means it goes in the US dollar. In order to get US dollars, I buy treasuries. If I'm in the US and I want safety, security, and liquidity, I go into US treasuries. So, because I get a guarantee payment from the government. So that's where I go to hide money in the event of a risk-off event. And that's really the way you think about things in this markets. Now, let's talk about the equity side of the ledger. On the equity side of the ledger, look, there's a tremendous number of companies right now that are doing exceptionally great things, right? I mean, you take a look at, some of these companies, AMC and GameStop, and we've talked about all these before in the past. That's fine. That's speculative behavior at its finest. And that works in a market like this right now, where there's lots of liquidity. People are taking on excess margin debt. People are taking out debt, personal debt right now to invest in the markets, something we haven't seen since 1999, by the way. But that's what investors are doing. So there's a lot of pressure emotionally to go chase those type of stocks. It's okay if you want to do it. Make sure that you use stop losses. Make sure that you have some kind of position management within your portfolio. When we have positions in our portfolios, they're never larger than 5% of the total portfolio, so that we have some risk sizing within our overall portfolio. When something is bigger than that, we trim it back down again. But if you're really looking to manage risk, start gravitating towards companies that can generate earnings in a weaker economic environment, that have long productive track records of sales growth. Now, not earnings growth. Be very careful with earnings. A lot of the earnings are being manufactured by stock buybacks, by a lot of accounting gimmicks. The thing you really can't manufacture is what happens at the top line. we have 14% of the S&P 500 right now trading above 10 times price to sales. That's one of the highest levels in history. And at 10 times price to sales, you cannot ever justify that level. We've got companies trading at 2 and 3 times that. NVIDIA trades at 24 times price to sales as an example. It will never justify that sales run based on its current price. It just simply can't sell enough to justify that level of price to sales. It will eventually catch up with it. When? Who knows? But by migrating your portfolio to things that do have strong, steady sales growth, that do have strong, steady earnings, that are great dividend payers over time, you can mitigate some of that risk of your portfolio of a very sharp, sudden sell-off, because this is the one factor that you've got that is different than before. We always talk about this time is different. This time is different in this one factor. It is not different from the standpoint that we're going to have 30, 40, 50% drawdowns. That will occur. This time is not different. What is different is the speed at which those things will happen. March of 2020 was a great example of this. Everybody's piling into these exchange traded passive indexing funds, which are fine. I've got nothing. We run an ETF portfolio. I'm right there with you. Nothing wrong with it. But understand that when everybody starts selling those ETFs, all those ETFs are selling the underlying individual stocks. Most of those ETFs own Apple. So when somebody starts selling Apple and selling the ETFs, you get double the amount of selling. And the problem is that always remember this one factor, and you know it. You've even said it yourself, I'm sure, more than one time or another. There's a buyer for every seller. Absolutely true. But you have to understand this one thing. There is a buyer for every seller. The question is always at what price? And on the way up in the market, every time somebody wants to sell something to take a profit, whatever the reason they want to sell it, there's an immediate buyer right there to buy it at that higher price. What happened in March of 2020 is that when the selling occurs, all of a sudden the buyers are way down here. There's nobody willing to buy on the way down. So when everybody shows up to sell all at once, there are no buyers, and the market will open up a gap in terms of price. And that's why you saw the market falling 1,000 points in a day, 2,000 points a day, 4,000 points. It was like, oh my God, that's that gap. And that is what is different going forward. Bear markets are no longer going to be functions of 6, 8, 10 months. They're going to be a 2-month affair, 50%, 60% down. And if you're not out before it starts, you're not going to have a chance to get out of it. And that's what caught a lot of people in March of 2020. We were selling out of the market in February of 2020 because we saw what was coming with the pandemic. So we were getting out. And then when March hit, we got the rest of the way out. But it was too late for most people to sell into that decline because it happened so fast. And that's going to be the future.
Excellent. Thank you very much for that. People really need to understand how it is, because for a lot of individuals, they buy what they know, meaning they have an Apple phone, they buy Apple stock. They use an Apple computer, they buy Apple stock. They, get Amazon products, they buy Amazon stock. And while, hey, that's worked out, I don't think it's a long-term solution to, structuring a portfolio. Look, if you got $1,000 or a few $1,000s in it, let it ride, I guess. But if you're trying to actually create sound investment that persists over decades, I think we need to be definitely more intelligent about where we're putting our money. Yeah, that's the way I see it anyway.
No, I think you're absolutely right. And look, in buying what works, right? And I'm not an anti-Apple guy. Or we own Apple, we own Amazon, we own Microsoft, right? Same reasons, right? These are good quality companies. Where you're specifically correct is when you're buying a company like AMC or GameStop, and really even outside of that, when you start getting companies like Asana and Palantir and Snowflake, a lot of people buy these things because of the name and the price that they're going up. They really have no idea what the company actually does. And that's really kind of your first clue, is that if you're buying a company and without having to Google it, you don't know what they do, don't buy the stock until you go Google it and figure out what the heck they do, and you really understand what the business model is. We have more companies that are public today that do not manufacture revenue than since 1999. This is a problem, and we've got people chasing a lot of companies that cannot generate revenue. Make sure you don't own those, because those are the ones that are going to hurt you when the market does break down eventually.
Absolutely. I wanted to ask for everybody. I know I show the real investment advice all the time on the channel, but if you wouldn't mind giving people, some way to see your products, your services, if you want to highlight those for them.
Sure. Well, no, I think the best way to go, and we do a radio show every day of the week. We do podcasts like you do, and all of it's kind of based around this. And we never promote products, right? We never say, "Oh, yeah, we manage." We manage money for individuals, retirees, and we do financial planning, estate planning. Yes, we do all of that. But I think the real value for your listeners is to go to realinvestmentadvice.com, read the blogs that we post, subscribe to our newsletter. We tell you every week in our newsletter, this is what we're doing on our portfolio. This is what we think. This is what we see. These are the risks, right? To try to help get you to where you want to go. But the best factor on that website is the ask a question button, because if you ask a question, I answer every email every day. It comes right to my desk. It's not somebody else answering it. It's me. But ask me a question, I'll answer it for you. I do it every single day for everybody. It's a no cost, no charge, no obligation. Nobody's going to spam you. But look, the whole purpose of Real Investment Advice is to help investors, and that's what we're here to do. Anything outside of that is certainly free to investigate, but I think that's the best place to start.
Excellent. Once again, for myself and my subscribers, thank you for coming on today.
My pleasure. Anytime.